What if the American economy is already breaking down, but the numbers you see every night are telling you the exact opposite story? Across the country, small storefronts sit dark with for rent signs fading in the windows. In once busy rural towns, factories are silent and paychecks no longer keep up with rent or groceries. Yet on Wall Street, the screens glow green. The S&P 500 pushes to new highs. Gold breaks another record. Traders celebrate as if prosperity has returned. This is the everything bubble, a moment where the real economy and the financial market no longer move together. In recent years, real economic growth slowed while financial markets added trillions of dollars in market value. Not because productivity surged, but because money became easier than ever to create.
It feels like a glitch in the matrix, doesn't it? The economy is struggling, but the stock market is partying like it's 1999. Why? Because the money isn't real.
So why do asset prices look so healthy in an economy under strain? Has the market gone insane? No, the market is intoxicated. And to understand why, we must find who keeps refilling the glass. Liquidity is one of the most misunderstood forces in the American economy, yet it quietly decides who survives and who sinks. To most people, liquidity sounds harmless. It feels technical and distant. But in reality, liquidity is the oxygen of financial markets, and the Federal Reserve controls the valve. Imagine the entire financial system as a vast swimming pool. The water in that pool is money. The boats floating inside are assets like stocks, houses, and gold. When the water level is low, only strong boats stay afloat. Weak boats scrape the bottom and eventually sink. In that world, prices rise slowly and mostly because companies improve productivity, invent better products, and earn real profits. Now picture what happens when the Federal Reserve opens the tap. New money pours into the pool. The water level rises.
So forget about building a better boat. In this game, a leaky canoe floats just as high as a yacht, as long as the Fed keeps pumping water into the pool.
Suddenly, every boat begins to float higher. Strong boats rise too. Even boats that should not survive remain afloat. The quality of the boat no longer matters. What matters is the water level. This is the liquidity illusion. Asset prices appear healthier, not because the economy is stronger, but because the measuring stick itself has changed. In the past, rising stock prices usually followed rising earnings. Home prices reflected wages and local growth. Today, prices rise because money is cheap, abundant, and constantly replenished. On screen, a simple demonstration makes this clear. A glass tank sits on a table. Inside are small models of houses and cars. As water is poured in, every object rises together. Nothing about the models improves. Their structure stays the same. Only the water level changes. The value of the house does not magically increase. The monetary water around it does. After major crises, this approach became policy. Following 2008, and again after the pandemic, the Federal Reserve flooded the system with liquidity to prevent collapse. The intention was stability. The result was distortion. Markets learned a dangerous lesson. Prices no longer need strong fundamentals. They need access to cheap money.
Markets used to care about profits, innovation, sales. Now, they only care about one thing. When is the next check coming from the central bank?
For ordinary Americans, this creates confusion. Wages lag behind, living costs climb, savings lose purchasing power, yet headlines celebrate record markets. This is not prosperity spreading through the economy. It is liquidity lifting everything at once, creating the illusion of wealth while the foundation quietly weakens beneath the surface. Understanding this illusion is the first step, because once the water keeps rising, the question is no longer whether boats float, it is who owns a boat at all. At the center of this system sits a cold and unforgiving reality. It is not ideology, it is not politics, it is arithmetic. And this arithmetic has trapped the United States government inside a narrow corridor with no clean exit. The numbers begin quietly, buried deep inside budget tables that few Americans ever read. Federal debt has climbed beyond $34 trillion, the largest pile of public debt in human history. Each year, that mountain grows higher. Each year, it demands interest, and interest is not optional. It must be paid before anything else. In Washington, behind closed doors and long conference tables, the math is clear. As interest rates rise, the cost of servicing that debt explodes. In recent years, annual interest payments have surged toward levels that rival and now exceed the entire defense budget. The United States is spending more to pay past promises than to fund its military. This is not a political talking point, it is a balance sheet fact.
This is where the trap snaps shut. If the Federal Reserve keeps interest rates high, borrowing costs continue to climb. Treasury auctions become more expensive. Refinancing old debt becomes painful. Eventually, confidence cracks. A government that cannot afford its interest payments edges toward default. Markets panic, pensions wobble, the financial system freezes. No elected official survives that scenario. Default is not just an economic failure, it is political extinction. The alternative looks safer on the surface. The Federal Reserve lowers rates. It buys government bonds. New money enters the system. Debt becomes easier to roll over. Interest costs fall in real terms. The government survives another year, but the price is inflation. In this world, obligations are honored but quietly diluted. Dollars still pay the bill, yet each dollar buys a little less. The debt does not disappear. It dissolves slowly through purchasing power erosion. This is why inflation is often called a hidden tax. No vote is required, no announcement is made. The cost is spread across every saver, every worker, every retiree holding cash. The mechanism repeats with mechanical precision. Rising rates threaten solvency. Falling rates threaten currency value. There is no third door. Productivity growth alone cannot rescue a debt load of this size within a political cycle. Spending cuts large enough to matter are electorally impossible. Tax increases sufficient to close the gap risk economic contraction. So policymakers choose the path that hurts slowly instead of instantly. Inflation wounds quietly. Default kills loudly. Scenes shift from trading floors to ordinary households. A family in the Midwest watches grocery bills climb faster than wages. A retiree sees savings earn interest that fails to match rising prices. A small business struggles as costs jump while demand weakens. None of them voted for inflation, yet all of them pay it. This is the mathematics of doom. Once debt reaches a certain scale, the system loses flexibility. Choices narrow, outcomes harden. Printing money is no longer a preference, it becomes a necessity disguised as policy. Politicians do not wake up eager to debase a currency. They wake up facing spreadsheets that offer only two options: collapse now or inflate later. History shows which one they choose. Inflation preserves the system and postpones the reckoning. Default ends careers. Understanding this trap changes how the present moment looks. Rising prices are not a mistake, they are a strategy. And as long as the debt remains this large, the printing press remains the only lever that still moves. Over time, repeated rescues changed not only markets but behavior. What began as an emergency response slowly became an expectation, and expectations, once embedded, reshape an entire system. The pattern is visible in hindsight. In 2008, as the global financial system froze, the Federal Reserve stepped in with its first large-scale asset purchases. Markets stabilized, collapse was avoided. The message was subtle but powerful. When the system is threatened, the central bank will intervene. A decade later, that lesson returned with greater force. In 2020, as the pandemic shut down cities and supply chains, the response was immediate and overwhelming. Trillions of dollars entered markets in months. Asset prices recovered faster than jobs. Stock indices reached new highs while millions remained unemployed. Once again, the fall was stopped. By 2023, the expectation was no longer abstract. When a major regional bank failed, emergency facilities appeared almost overnight. Depositors were protected. Contagion was contained. The market did not question whether help would arrive, it waited for how fast. This is the Fed put, the belief that significant losses will be met with intervention, that risk is capped not by fundamentals but by policy. For investors, this changes everything. Fear fades, caution weakens, risk-taking feels rational because downside appears insured.
The psychology is visible on trading floors and in portfolios across the country. Leverage increases, speculation grows. Assets are bought not because they generate lasting value, but because they are expected to be supported. The question shifts from, is this investment sound, to, will the Fed allow it to fail? A simple image captures the effect. A child learning to walk stumbles forward. Before the fall, a parent lifts them upright. Again and again, the child is rescued. There is no pain, no consequence, and no learning. Balance never develops because failure never completes its lesson. Markets behave the same way. Losses are truncated, corrections are softened. Each rescue reinforces the belief that risk no longer carries its traditional cost. Over time, capital flows away from productive investment. Building factories, training workers, and developing technology involves uncertainty and long timelines. Speculating on assets backed by policy support feels safer and faster.
The result is distortion. Financial markets grow larger than the real economy that supports them. Prices decouple from underlying productivity. Wealth concentrates in assets rather than income, and innovation slows where it matters most. For everyday Americans, this creates a widening divide. Those who own assets benefit from repeated rescues. Those who rely on wages face rising costs and limited upside. The system appears stable from above, yet fragile underneath. This is the savior trap. Each intervention prevents immediate collapse but deepens long-term dependence. The market becomes less resilient with every rescue, and the Federal Reserve becomes not just a regulator, but the emotional anchor of the system. As long as this belief persists, liquidity will chase protection instead of productivity. And the longer markets rely on salvation, the harder it becomes to imagine a world where they stand on their own again. As liquidity floods the system, a subtle illusion takes hold. It hides in plain sight, reflected in charts, account balances, and headlines announcing record highs. This illusion lives in the gap between price and value. Price is what you see. It is measured in dollars created by policy. It moves quickly and reacts to liquidity. Value is what you feel. It is measured in purchasing power, in what those dollars can actually buy: food, energy, shelter, time. When the two drift apart, wealth begins to behave like a mirror that distorts rather than reflects reality. Gold offers a clean example. On a chart priced in United States dollars, gold appears to surge upward over time. New highs arrive. Commentators speak of rallies and gains. It looks like appreciation. But when that same gold is priced against barrels of oil or against a broad basket of stocks, the picture changes. The line flattens. Sometimes it barely moves at all. Nothing magical happened to gold. Its role did not change. An ounce of gold today performs much the same function it did decades ago. What changed was the unit of measurement. The dollar around it weakened. The mirror stretched. The same illusion appears across financial markets. Stock indices climb to records. Retirement accounts look larger. Net worth statements glow brighter. But then the camera cuts to everyday life. A grocery aisle where prices reset every few months. A gas station sign that refuses to fall. A rent notice rising faster than income. This is the moment to ask the only question that matters. Not how high did the market go, but what can that money buy now? How many hours of labor does it represent? How many weeks of food? How much shelter? For those holding assets, rising prices can feel like success. For those holding cash, the experience is very different. Savings accounts grow slowly while costs accelerate. Fixed incomes fall behind. Pensions promise stability, yet quietly lose purchasing power year after year. This is how impoverishment happens without a crash. There are no riots in the streets, no sudden bank closures. Instead, value drains slowly. Each month, cash buys a little less. Each year, the gap widens. Those who saved diligently discover that discipline alone is no defense against dilution.
Scenes shift from trading terminals to kitchen tables. A retiree recalculates a budget. A young family delays a home purchase. A worker realizes that raises no longer keep pace with living costs. None of them participated in speculative excess, yet all absorb its consequences. The mirrors of wealth reward those closest to the source of liquidity. Asset holders see reflections of growth. Savers see erosion. The system does not announce this transfer, it executes it quietly, through prices. Understanding this difference reframes everything. A rising market does not automatically mean a richer society. It may simply mean a weaker measuring stick. When prices rise faster than value, wealth becomes an illusion that benefits some while slowly extracting from others. And once you see the mirror for what it is, you stop celebrating reflections. You start asking what remains real behind the glass. As the illusion deepens, attention turns forward, not to markets alone, but to politics, because liquidity is never neutral and it is never separated from power. Every election cycle brings the same unspoken pressure. Voters do not read balance sheets, they feel conditions, jobs, wages, markets, confidence. When growth weakens and costs rise, governments search for speed. Structural reform takes time. Productivity gains take years. Liquidity works immediately. As 2026 approaches, that pressure intensifies. Whether through a new administration or shifting leadership at the Federal Reserve, the incentive remains unchanged. The economy must look strong. Markets must stay calm. Recession headlines must be delayed. The fastest lever is always the same: easier money.
Scenes move from campaign stages to closed policy meetings. Charts are projected on walls. Growth forecasts are revised. The message is familiar: stabilize now, adjust later. Elections are measured in months, not decades. A weaker dollar fits neatly into this picture. For the United States, currency strength is a double-edged sword. A strong dollar raises the real burden of debt and weakens exports. A softer dollar does the opposite. It supports manufacturing competitiveness and quietly reduces the real value of what the government owes. No legislation required, no votes cast. History suggests where this leads. Interest rates may fall, but prices do not. Inflation remains stubborn. The gap between the two becomes policy by design. Real rates turn negative. Savers earn less than inflation. Borrowers benefit. Debt becomes easier to carry as its value erodes over time. This condition is often described as temporary. In reality, it becomes normal. Negative real rates are not an accident. They're the only environment where massive debt loads remain manageable without default. For governments, this is stability. For citizens holding cash, it is slow extraction. Every decade has a defining rule. For the coming one, that rule is simple. Money held still loses ground. Assets move with the tide. Productivity matters less than proximity to liquidity. Scenes return to everyday life. A bank statement showing interest earned, a receipt showing prices paid. The math no longer works in favor of patience. It rewards positioning. The shift of 2026 is not a sudden break, it is a continuation. Political cycles will reinforce monetary ones. Short-term appearance will outweigh long-term repair. And inflation, managed rather than defeated, will quietly remain part of the system. This is not a forecast of collapse, it is a description of incentives. And incentives, more than intentions, decide the future. As the flood of liquidity continues, survival begins with a shift in mindset. This era is not designed to reward patience in cash or perfect timing in markets. It rewards understanding. The goal is no longer to get rich quickly. It is to preserve purchasing power while the monetary tide keeps rising. For decades, investors were taught to analyze fundamentals and wait. That lesson still matters, but it is no longer enough on its own. When money is created at scale, standing still becomes a decision with consequences. This is why one rule echoes across every cycle of modern markets: don't fight the Fed.
When liquidity flows, resisting it does not create safety, it creates vulnerability. This does not mean blind speculation, it means aligning with the environment as it exists, not as it used to be. When central banks expand balance sheets, assets absorb that expansion. Cash does not. The water rises, and those without a vessel feel it first. Scenes shift to different forms of protection. Scarce assets have played this role for generations. Gold and silver have preserved value through wars, inflations, and regime changes. They do not depend on earnings or promises. They exist outside the system. Real estate functions similarly when chosen carefully. Land and shelter remain essential regardless of monetary policy. For those with higher risk tolerance, digital scarcity has entered the conversation. Bitcoin represents an attempt to create value beyond central control. It is volatile and uncertain, but its role reflects a deeper demand for assets that cannot be diluted at will. Equities still matter, but not all businesses are equal. Companies with pricing power can raise prices as costs rise. They protect margins when inflation persists. Businesses without that ability struggle. In an inflationary world, ownership matters more than growth stories. This is not about prediction, it is about adaptation. No individual can stop the printing press, no household can vote inflation away, but choices can be made within the system as it operates today. The camera returns to the narrator, steady and direct. Decisions made now are not about chasing 10 or 20% returns. They are about whether decades of effort retain meaning in the future, whether savings translate into security, whether work done today still feeds tomorrow. The conclusion is simple, but not easy. The flood cannot be stopped. Liquidity will keep rising because the system demands it, but people can choose how they face it. Sit still and let the water erode purchasing power year by year, or build a vessel that moves with the tide. Do not let money decay quietly in accounts that promise safety but deliver loss. Transform it into assets that endure. In an age of endless liquidity, survival belongs not to the fastest, but to those who understand what the water is doing and prepare before it reaches their door.